An auto insurance company looks like it just sells peace of mind for a monthly fee. Pay your premium, hope you never need to use it, and hope for the best. But the real profit rarely comes from anyone actually driving safely at all. Most people assume an insurance company earns money the same way a store does. Collect premiums from many drivers, pay out claims to the few who crash. Whatever's left over after paying claims becomes the company's profit. Plain and simple. That explanation feels reasonable, since insurance is often described as pooled shared risk. Thousands of safe drivers effectively subsidize the unlucky few who actually get into accidents. It would make sense if premiums minus claims was the entire profit equation. But insurance companies often pay out nearly as much as they collect in premiums. Some years, claims and expenses actually exceed the total premiums collected that same year. On paper, that sounds like a company that should be quietly losing money. Yet auto insurers remain some of the most consistently profitable companies in finance. If claims alone explain the math, that consistent profit should not really be possible. So the premium itself was never actually the main source of the real profit. The real engine sits somewhere most policyholders never think to look for it. It has almost nothing to do with how carefully anyone drives their car. Every policy starts with a price, and that price is never actually random. Insurers build detailed risk models using age, location, driving history, and vehicle type. Each factor shifts the price up or down based on statistical accident likelihood. A driver in a dense city typically pays more than one in a rural area. More traffic simply means more statistical opportunity for an accident to happen. Younger drivers pay significantly more, since their accident rates run higher, on average. That is not personal judgment. It is simply what decades of claims data consistently show. Insurers also factor in the specific vehicle, since some models cost more to repair. A car with expensive parts or complex electronics raises the cost of any claim. In some markets, even credit history quietly factors into the final premium price. Insurers found a statistical link between credit patterns and the likelihood of filing claims. That link is controversial, but it is baked into pricing models in many regions. None of these factors are about punishing anyone. They are about predicting probability accurately. The more accurately an insurer prices risk, the more consistently profitable it becomes. Underpricing risky drivers leads to losses. Overpricing safe drivers loses them to competitors. That balance is the entire art and science behind the actuarial pricing department. Actuaries spend careers building models that predict, on average, who will file a claim. They are not trying to predict any single driver, just the pattern across millions. Across a large enough pool, that pattern becomes remarkably stable and predictable year to year. That predictability is what actually makes the entire insurance business model function at all. Get the pricing right, and profit becomes a matter of steady, disciplined math. Get it wrong, and even a well-run insurer can quietly bleed money for years. Here is the part almost no policyholder ever thinks about when they pay a premium. An insurer does not just sit on that premium money waiting for a claim to happen. They invest it, immediately, in stocks, bonds, and other financial assets, at scale. That pool of collected but not yet paid out money is called the float, inside the industry. At any given moment, a large insurer might be holding billions of dollars in float. That money sits invested, earning real returns, months or years before any claim gets paid. Warren Buffett famously built much of Berkshire Hathaway's fortune using this exact insurance float. The insurance business itself does not even need to turn a profit for this to work. As long as investment returns exceed any underwriting loss, the company still profits overall. This is why insurers can sometimes pay out more in claims than they collect. The investment income quietly covers that gap, and often adds significant profit on top. Bigger insurers with more float have a genuine structural advantage over smaller competitors. More float means more invested capital, which means more potential investment income at scale. That is part of why the largest insurers keep getting larger over time, not smaller. Interest rates directly affect how profitable this float strategy becomes, year to year. Higher interest rates mean that same float earns significantly more in safe, stable returns. That is why insurance company profits often swing with broader interest rate cycles closely. None of this shows up on a policyholder's bill or renewal notice ever. The premium looks like a simple transaction, a fee paid for coverage and protection. Behind that simple transaction sits an entire, sophisticated investment operation, working quietly. The float is arguably the single most important, least visible part of this business. Everything else in the industry gets built around protecting and growing that same float. When an accident happens, the claims process determines exactly how much actually gets paid. Insurers employ trained adjusters whose job is to evaluate every single claim carefully. Part of that evaluation is confirming the claim is legitimate and accurately documented. But another part of that evaluation is minimizing the payout wherever legally possible. Initial settlement offers run low, often 30% below a claim's likely final value. Most policyholders accept that first offer, simply because they do not know to push back. Pushing back, providing more documentation, often results in a meaningfully higher final payout. Adjusters are not necessarily acting in bad faith. They are following company guidelines and training. Those guidelines are built, in part, around managing the company's overall loss ratio. A lower average payout per claim directly improves that company's underwriting profitability. Some claims get delayed, sometimes intentionally, since delay itself reduces the pressure to settle high. A frustrated claimant under financial pressure is statistically more likely to accept a lower offer. This dynamic exists across the industry, not as an isolated practice at one company. Some states and regulators have specific rules limiting how insurers can handle these delays. Public adjusters and attorneys exist specifically to help policyholders push back against low offers. Hiring one often recovers meaningfully more money, even after their own fee is paid. Most people never bother, since the process already feels confusing and exhausting enough. That exhaustion, quietly, becomes part of the company's overall claims cost strategy. In practice, fraud detection also plays a real role, since some claims genuinely are exaggerated or false. Investigating fraud protects honest policyholders too, by keeping overall premiums lower across the pool. The claims department sits at the exact center of the company's actual profitability. Quietly, how a claim gets handled often matters more than how the original premium was priced. Beyond the base policy, insurers sell a long list of optional add-on coverages. Roadside assistance, rental car reimbursement, and accident forgiveness are common upsells, offered at sign-up. Roadside assistance alone often adds $7 a month, stacked onto the base rate. Individually, these add-ons look minor, often just a few dollars added each month. Across an insurer's entire customer base, those small add-ons add up to real revenue. Many add-ons also carry higher margins than the core auto policy itself. Structurally, the base policy is heavily regulated and closely watched by state insurance departments. Add-ons often face lighter regulatory scrutiny, giving insurers more pricing flexibility around them. Accident forgiveness sounds like a favor, waiving a rate increase after your first accident. In practice, its price is calculated to profit the insurer over the policy's lifetime. Gap insurance, covering the difference between a car's value and the remaining loan, sells similarly. It is genuinely useful for some drivers and genuinely profitable for the insurer offering it. Agents are often trained or incentivized to present these add-ons during every new sign-up. A well-trained agent can meaningfully increase a policy's total value through these add-ons alone. Customers rarely negotiate add-on pricing the way they might negotiate the base premium. That is partly because add-ons feel small, and partly because comparing them is genuinely difficult. Few people cross-shop rental reimbursement pricing the way they cross-shop the base policy rate. That lack of comparison shopping is exactly where add-on margin quietly protects itself industry-wide. None of these add-ons are dishonest. Most genuinely deliver the coverage they promise. But they are priced with the same underwriting discipline as everything else the company sells. Layered together, add-ons turn a single policy into several smaller, separately profitable products. That layering is a quiet, consistent source of margin most policyholders never fully notice. A newer pricing tool has emerged that tracks how someone actually drives in real time. Telematics programs use a phone app or a small plugged-in device to monitor driving. They track hard braking, speed, mileage, and even what time of day someone drives. Safer measured driving behavior can unlock a meaningful discount on the overall premium. That sounds like a straightforward win for careful drivers, and often genuinely is one. But the data collected also flows directly back into the insurer's broader pricing models. Every trip recorded refines the company's understanding of risk across its entire customer base. That refined understanding lets insurers price future customers with even greater statistical precision. More precise pricing means fewer underpriced risky drivers slipping through at a discounted rate. It also means safe drivers increasingly subsidize fewer of the industry's genuinely risky ones. Some insurers have started offering telematics as the default option for brand new customers. Declining to participate can sometimes mean missing out on the best available starting rate. The data itself has real value beyond just pricing a single individual policy accurately. Aggregated driving data across millions of trips becomes a genuinely valuable dataset on its own. Some insurers have explored using or licensing that aggregated data for other purposes entirely. Traffic pattern insights, for example, have real value to city planners and other industries. None of this requires a single additional dollar spent building new physical infrastructure. The phones and devices already exist. The data collection itself is remarkably cheap to run. That makes telematics one of the highest margin tools in modern insurance pricing, structurally. It also quietly shifts more of the pricing burden onto individual, measurable behavior over time. The days of one flat rate for an entire demographic group are slowly disappearing. Driving itself has quietly become a source of data, not just a source of risk. New customers researching insurance almost always see the most competitive rate an insurer offers. That rate is specifically designed to win business away from a competing insurance company. Once that new customer signs up, the pricing relationship gradually starts to shift over time. Renewal after renewal, small rate increases accumulate, often faster than general inflation alone. Independent studies have found something surprising. Loyal customers often pay 20% more. Industry insiders sometimes call this pattern the loyalty penalty, openly, inside the business itself. It sounds backwards. Loyalty should logically be rewarded, not quietly and steadily punished. But loyal customers are statistically less likely to shop around and compare other rates. That inertia is worth real money to an insurer trying to protect its own margins. Comparing insurance rates takes real time and effort most people simply do not want to spend. Insurers know this, and price accordingly for the customers unlikely to ever switch providers. A customer who calls to complain about a renewal increase often gets a quick discount. That discount exists specifically because the company knows exactly which customers are about to leave. Silent customers who never call and never negotiate simply keep absorbing the slow increases. This creates a strange incentive structure where staying loyal is often the worst financial choice. Shopping around every year or two frequently results in a meaningfully lower overall rate. Most people do not realize this and assume their current insurer offers a fair ongoing rate. That assumption, quietly, is exactly what keeps the loyalty penalty profitable across the entire industry. Some regulators have started examining this pattern more closely in recent years. In several states, a few insurers have begun capping how much a renewal price can rise publicly. But industry-wide, the underlying incentive to price this way largely has not gone away. The best rate you will ever get from most insurers is usually the very first one. No single insurance company wants to hold all the risk from a major disaster alone. That is where reinsurance comes in. Insurance that insurance companies buy for themselves, essentially. An insurer pays a reinsurer to absorb part of the risk from catastrophic events. In exchange, the reinsurer takes on a share of any resulting massive claims payout. This protects the original insurer from a single hurricane or disaster wiping out its reserves. It also lets that insurer write more policies than its own capital alone would allow. Reinsurance effectively expands how much risk an insurance company can safely take on. Larger insurers negotiate reinsurance deals with more leverage than smaller, regional competitors can manage. That scale advantage compounds over time, letting bigger insurers grow even larger steadily. Risk pooling works on a similar principle, just applied across an insurer's entire customer base. A larger, more diverse pool of policyholders smooths out random year-to-year variation. One bad accident year in one region gets balanced by quieter years somewhere else, nationally. That stability lets large insurers price more confidently and profitably than smaller, regional ones. Scale also reduces administrative cost per policy, since fixed costs spread across more customers. Claims processing systems, actuarial teams, and compliance staff all become more efficient at scale. That efficiency is a big part of why the auto insurance industry has consolidated significantly. Smaller regional insurers increasingly struggle to compete with the pricing power of national players. Bundling home and auto policies together is another scale strategy insurers actively encourage. Constantly, a bundled customer is statistically less likely to shop around and switch either policy. That bundling quietly increases both retention and the total premium collected per household. None of this scale advantage is visible on any individual customer's monthly bill, but it is quietly one of the strongest structural advantages the largest insurers actually hold. This entire business depends on one quiet assumption, that historical accident data predicts the future. Climate change has started making that assumption noticeably less reliable in several regions. Extreme weather events are increasing in both frequency and severity across many markets. That unpredictability makes accurate risk pricing meaningfully harder than it used to be. Some insurers have started pulling out of high-risk regions entirely, rather than reprice. That withdrawal leaves fewer options for drivers in exactly the areas that need coverage most. Rising vehicle repair costs are also squeezing margins across the entire industry consistently. Modern cars carry expensive sensors and electronics that dramatically raise the cost of any repair. A minor fender bender today can cost far more to fix than a decade ago. That rising repair cost eats directly into the underwriting side of the profit equation. Interest rate swings also threaten the float strategy that so much profit quietly depends on. When rates fall, that same invested float earns meaningfully less than it once did. Some insurers have had to raise premiums specifically to offset weaker investment returns publicly. Regulatory scrutiny is also increasing around both claims handling and the loyalty penalty pattern. Several states have introduced rules requiring more transparency around renewal pricing practices recently. That transparency could meaningfully shrink one of the industry's quieter profit sources over time. Comparison shopping tools and apps have also made rate shopping far easier than before. A customer can now compare quotes across multiple insurers within just a few minutes online. That convenience directly threatens the inertia the loyalty penalty has always depended on. Telematics adoption is a double-edged sword for insurers as well, in the long run. As more competitors adopt usage-based pricing, that early data advantage slowly becomes the norm. Autonomous and semi-autonomous vehicle technology adds another layer of long-term uncertainty industry-wide. Fewer human driving errors could eventually mean fewer accidents and fewer claims overall. That shift, if it continues, would fundamentally challenge how this entire business model works. None of these pressures are fatal to the industry on their own individually, but together, they are quietly forcing insurers to rethink strategies built over many decades. The companies adapting fastest are investing heavily in better data and more precise pricing models. Others are leaning harder into scale, bundling, and reinsurance to protect their existing margins. The quiet, boring insurance office is becoming a more technical, more competitive business steadily. Staying profitable now requires treating this like a data business, not just a risk pool. So here is the real model, stripped down to what actually makes an insurer profitable. It was never simply premiums collected, minus claims paid, equals whatever's left over. It is about pricing risk precisely, then investing that premium money before any claim arrives. The float quietly does more work than most policyholders will ever realize or see. Claims handling protects margin just as much as pricing does, quietly, claim by claim. Add-on coverages turn one policy into several smaller, separately profitable products, stacked together. Telematics data refines pricing further, while quietly becoming a valuable asset on its own. The loyalty penalty rewards new customers and slowly, steadily overcharges the ones who stay. Reinsurance and scale let the largest players absorb risk smaller competitors simply cannot handle. None of these pieces work particularly well in isolation. They compound across every single policy. That is why an industry that looks simple on paper runs on genuinely sophisticated math. The premium was never really the full story from the very first policy onward. The real story was investment income, careful claims handling, and a quiet pricing advantage. Climate risk, rising repair costs, and easier rate shopping are starting to test that model. The insurers that survive that shift will be the ones pricing risk most precisely. Everyone else sees a monthly bill and a card in their glove compartment, nothing more. The person who built the pricing model sees a carefully balanced, constantly adjusting system. That is the gap between a simple monthly bill and a genuinely sophisticated financial business. Next time your renewal notice arrives with a higher number, do not just pay it quietly. Call and ask why, or compare a few other quotes before you renew automatically. That one phone call is often worth more than anything printed on the policy itself. The premium was never fixed. It was simply the price nobody had challenged yet.